Today we're going to talk about the economic indicators. So, Mark, from your perspective, what are you feeling the key indicators that business owners and portfolio investors should be paying attention to right now in this kind of turbulent um, geopolitical kind of environment?
The most important thing I would share here, Trevor, is to ignore the news. It is far too easy to get swallowed into the day-to-day news cycle. What did Trump say today? What happened in the Ukraine today? What happened in XYZ? Who did that? What earnings report happened? The media in general is designed to make us think very short term, very dramatic, with a semblance that the world is about to end. And I can always tell when I speak with folks that are very worried about the world because they're the ones that watch the most news. And those that disconnect and create, whether it's time limits on their phone of screen time, or what I did, I canceled CNN. I don't even want it on my TV. I don't even want to have the ability to turn that on my television anymore. And so I would say if you can ignore the noise and get very specific about what's going to affect your business, your family, your portfolio, whatever you want to focus on here, we can go any which way we like here, Trevor. But the key indicators, there's actually very few that you need to pay attention to. Of course, there's some industry dependent ones depending on what your business is in. But from a high level part, we pay a lot of attention to the unemployment data. Unemployment is the easiest way to think of how our economy is doing. So, how our economy is doing, simply put, if there's fewer people working, there's fewer people spending. And in North America, we are a consumer driven economy, both Canada and the US. 75% approximately of our economy can be drawn back to consumer spending. So if the consumer is working, earning income, doing well, guess what? They're spending money. And if our unemployment rate continues to creep higher, there's an issue there. So our belief here is that as long as unemployment stays below 8%, then our economy will not slow down to the point of that R word recession. And we are very likely going to continue to tick along despite all the challenges that we see, whether it's in real estate, our global economy, whatever. But as long as the consumer is working and spending, we're doing okay. Present day, our unemployment rate 6.9%. And so we are creeping up, absolutely. And so that's the indicator. If you were to watch only one indicator, it would be the unemployment rate on both sides of the border.
Interesting. When you were chatting about not watching the news, I can't remember what book it was, but I remember reading a book many years ago, and one of the thoughts in the book was like, don't watch the news. If anything ever important happens, someone will tell you. So, so it's kind of funny that that just popped in my head. Um, on a side note, with the economy, like being in our business, like we have a lot of people in different industries, so we kind of get like the ground, ear to the ground kind of indicators. And someone just came in, I think it was yesterday, and they volunteer at one of the local food banks, and they were basically saying that the shelves are bare. So like to me, that's just perhaps an indicator that the food banks are being used a little bit more than normal. But anyway, cool. But the news does drive some other things like interest rates and what I've been hearing is, it's projected that interest rates are going to be coming down, at least in Canada, in over the next 12 months. I hope so. My mortgage is coming up for renewal next summer. But what are your thoughts on interest rates and where they're headed?
I'll clarify first, Trevor, by saying that mortgage rates aren't driven off of interest rates. Mortgage rates are based off of the 30-year Government of Canada bond yield. And that government of bond yield is directly correlated to how banks price mortgages. So, how is the bond market moving? We can get to that in a moment. we could talk about your mortgage, Trevor. And but for now, we'll talk about interest rates. So interest rates, when interest rates go down, it's a bad thing to remind everybody here, because interest rates going down means the economy is weak, and the Bank of Canada or the Federal Reserve in the US are trying to stimulate the economy to pick it up. So whenever we see a rate cut, it's because we are seeing negative economic data. Negative economic data could be, um, again, we could talk about unemployment, we could talk about inflation. There are several indicators that the Bank of Canada and the Federal Reserve pay attention to. The most important one, though, is unemployment. So if you get a negative jobs number next Friday, we see unemployment data on the first Friday of each month on both sides of the border. If we get negative data, meaning there's more unemployment that came to us over the month of November, and if we see that the first Friday of December, I can almost guarantee that we'll see interest rates cut, specifically in the US. The US is behind us by way of the speed of interest rate reductions. Tariffs scared the Bank of Canada into lowering rates faster. And so that's why the Bank of Canada has lowered rates much quicker to try to protect the Canadian economy as best as they're able. And so we are, to use a baseball analogy, probably in the eighth or ninth inning in interest rate reductions in Canada. And in the US, we're probably in the fifth inning, I would say, that there's probably between 2 to 4 cuts that we'll see in the US over the next 6 to 9 months. Canada, maybe one or two. We're pretty close to the bottom of where the Bank of Canada wants interest rates to be. Interest rates are, again, you don't want them too low, and they want to keep the proverbial powder dry, that if some sort of external event happens, that they're able to shock the economy into better repair by lowering rates right away, as we saw during COVID and the financial crisis and the tech bubble, where they basically took interest rates into their own hands to try to give confidence back to the economy. So those are two different parts, interest rates and mortgage rates. And we could dive in there if there's time, Trevor.
Yeah, but well, also the interest rates also, like from a global perspective, affect currency exchange.
Yes.
And a lot of Canadians like to travel somewhere warmer, which is usually, into a country that has like a US based currency or something. But and also there's, a lot of people that sell into the US and other areas. Where do you think um our our currently weak dollar is going to be going, and hopefully it's only, stronger, um, over the same kind of interim term of like 12 months or so.
Yeah, so currency is a very interesting one. We have about 75% of our Canadian economy is reliant on the US. So our currency rate, our FX rate, is extremely important to understand what moves it and why it will move. The primary piece to realize, number one, is that we are globally looked at as a petrol dollar. We're an oil dollar. And so oil hovering around $60, really not done a ton this year in terms of performance. That's holding a lid on our dollar. So there's global reasons, there's American reasons, there's Canadian reasons that oil has not moved a lot this year. $60 is really the magic point that oil stays at. CapEx spending, meaning oil companies can spend on finding more oil. It's economically worthwhile to them at $60 a barrel. So 72 cents per dollar is where we are right now, give or take a bit, of course. And our dollar is going to be stuck in this sort of 69 to 74 range until we're able to get clarity on oil, to get oil moving. I don't think oil will be moving materially higher, as what OPEC tells us is that they're keeping control on production to keep oil around these current levels. So that's something that's important to remember, that oil is very much going to dictate the Canadian dollar. The other matter that will affect the Canadian dollar is the US dollar. And what will move the US dollar down or up? Um, it's secret, it's interest rates. And our interest rates, or sorry, the American interest rates, if they were to lower those interest rates, it would effectively devalue their dollar, make their dollar worth less. So if we see that 2 to 4, like I mentioned, interest rate cuts in the US over the next 6 to 9 months, we will likely see weakness in the US dollar, which will likely push our dollar up 1 or 2 cents to and that higher end of the range that I mentioned earlier, somewhere in the 73 to 75 range.
Cool. Um, wanna change gears a little bit. Not that I've been listening to the news because you told me not to, but there's been a lot of chatter or debate about like, AI stocks or bubbles or whatnot. Being overvalued. There's the guy from, the movie The Big Short that is basically, you know, telling us again that this is just another bubble that's about to happen. So, without getting specific on any one stock or company, what are your thoughts? Are they overvalued? Is this part of the cycle? Is this
Um,
spending or
so
growth like sustainable?
Yeah, I think, most of listeners will have known the acronym Magnificent Seven, which are the seven largest tech stocks in the US that are driving this AI boom. So think Nvidia, Facebook, Google, Amazon, Tesla, Facebook. I think I mentioned that anyway. So Amazon, I mentioned it, Apple. That's the one I forgot. So those seven companies are driving this parabolic increase in the S&P 500, which is the 500 largest companies in the US. And of note, you could, of course, say on paper that they're all overvalued. It's easy to say that. But if you look at NVIDIA's quarterly earnings, which they reported last week, you will have learned that in the past 3 months, they sold something in the range of $57 billion worth of computer chips. And I don't know how to properly fathom $57 billion of computer chips. Maybe you can, Trevor, or listeners can. I can't. But what was most important though was NVIDIA always discloses what they have and what they call their order book, what's coming up, what they have by way of future orders. And their future orders were $60 billion over the next 3 months, even more than they sold in the past 3 months. And so that was a really pivotal earning moment there for us to see how the AI momentum is going. And there continues to be a lot of investment that arguably we're just at the very beginning of how AI will continue to evolve. And really, the roots of it is quantum computing and how quantum computing is going to change how everything operates. And COVID arguably accelerated all of this. Look at us sitting on a screen here. These computers require much faster computer chips than they needed 10 years ago to work. So, is this a bubble? No, I don't think we're in a bubble. I think we are in a cycle that there will be speed bumps, but I don't think this NVIDIA, as an example, is going to zero tomorrow. I think the media likes to make a lot of news and noise to make us all worried that the world is about to end, and an AI in general is just a fad. And it's actually not a fad. It's making everybody's lives more efficient, easier, and better. So you could draw any correlation that you like with, the root of example 1929. If you want to indulge me for 30 seconds here, the root of it, if you go back to the early 20s when radios started to hit homes, they started to go residential. Radio stocks basically went up 800% leading into the Great Depression. Great Depression hits, and over the next couple of years, they basically went down 99%. So radio stocks were a product that was new, went into a home, soared, then tanked. AI stocks are different because think of Microsoft as an example where they are the original investors in ChatGPT, which I'll make an assumption that everyone here is familiar with. And what they've done was they saw the adoption of ChatGPT and have very intelligently, properly gone all the way down and done what's called vertical integration, where they basically bought the entire system. So they went down to the bottom of buying the power grid because AI requires more electricity. So they're buying nuclear plants, they're buying coal plants, they're buying energy as a technology company. And so they then, to buy that, then they buy the device that you're going to use the AI on, and then they create the AI, ChatGPT in this example. All of these examples here are what all the technology companies are attempting to do, Trevor, to make sure that they aren't left behind. So we are due for a speed bump. And a speed bump, I can't properly tell you exactly what that will be. But if these stocks were to go down, pick a number, 20% in value, I would say that's a value purchase when you look at what AI will do relative to the world around us. I don't think these stocks are going down 70, 80%. I do believe that we may see some type of reprieve in the market, but I don't believe we'll be seeing any type of market crash. There's too much momentum behind it, and there's actual business happening with it. And simply look at any bank, any utility company, any power company, they've all got AI budget line items. And that tells us that the spending is happening in every industry. It's going up significantly every year, and it's making them more efficient and allowing them to have higher profitability, which is a good thing for us as shareholders.
So, like you talked about Magnificent Seven. Like, so, like, should we have just had the foresight to buy that, or buy the Nasdaq, the Qs, or like or like is it like what are your thoughts on diversification? Like, you're talking about a speed bump potentially coming up. If you were able to give us a date, we would all appreciate that, just by the way. But apart from that, that was a joke for those who don't know me so well. Like, what are your thoughts on, like, over being like overweighted in a certain sector, or underweighted, or whatnot? Like, what is your philosophy, I guess, as an advisor to
Yeah.
diversification?
So we believe in diversifying, but we believe in the themes we believe in. So the S&P 500 right now is approximately 45% weighted into those seven companies.
Wow.
If we were to equalize and those 500 companies get an equal share over those 500, the S&P 500 is actually fairly valued if we just equal all 500 companies. So what that means is there's of course some stocks that are down, some stocks that are flat, some stocks that are up, and then we have these Mag 7 stocks that are way up. And so what we're learning as we see that is the evening out, the averaging of all these 500 tells us that the market's fairly valued, which is why we don't really think we're in for some type of crater. And if these AI stocks go down 20, 30%, that won't, that will be maybe 5, 7, 8% off of the US stock market as a whole, which historically is normal. We historically, once a year at a minimum, the US stock market, the S&P 500, goes down by 10% on average once a year. And so that tells us that that's a normal, healthy move. And it would make complete sense if it came out of the AI trade. So, in terms of what to do with your portfolio, Trevor, it really depends on when you're going to need the money. So, if you were to tell me that I'm retiring and I need money next year, I would take a much more cautious view, perhaps look to do some profit taking and protecting money. If you were to tell me, Mark, I don't need this money for 20 years, then I would take a good look at the positions you own and make sure we're all comfortable with them. And assuming we are, we may very well do nothing we may very well just let that overweight continue to be. So our typical portfolio nowadays, we're holding somewhere in the range of 8 to 15%, 1 5, in tech stocks, these AI names. So they are an overweight relative to the overall portfolio. But it's simply, as I mentioned, when you believe the longer term theme of AI helping our world be better, think of the Industrial Revolution where railways made the world better. I think AI will make the world better. Will it make it better tomorrow? No. Will it get worse before it gets better? Probably. But when you think with a 30-year view, um, these stocks are just the beginning. And the real future of AI, those are companies that aren't even, if they exist, they're small private companies run out of someone's basement or garage. Like the future of AI, we don't even know where it's going. And so just being nimble and being educated is a good thing.
Yeah, I think I was reading something a couple weeks ago where the person was talking about um, like the AI sector being somewhat similar right now to the advent of computers into the business environment back in like the late 70s, early 80s. Like, people were all over it, and it did result in a reduction of lower skilled labor, such as, typists and other clerks and stuff like that. But it didn't really take full effect for a number of years until businesses figured out, like, how to use the new technology. So they were basically saying the same thing about AI. This is good. Has it resulted in increased productivity? Not as much as, people are expecting, because I think we're still learning how to use the technology. So, in a way that makes sense. Um, so we have, if we're going to talk about um, business owners specifically, like how can they align their strategy with, what's happening in the broader economy? Like, is there things that we can look at to help us, like, or at least be aware of, like, when we're planning? Like, right now is probably a little late in the cycle, but now is around the time where people often plan or budget for upcoming year. So is there
Mhm.
stuff that we can be, you know, considering, not driving, not being the be all end all of decision making, but stuff that we should be considering with respect to our business planning?
Yeah, I would, we just spent a few minutes on AI. I would figure out what are the AI tools that can increase your business's productivity. And there's no reason that you can't find another 2 to 5 hours a week in your schedule if you could figure out how to properly engage AI into your business. And that means different things to different industries, of course. But and Trevor, it could be with you. It could be something to do with automating some type of the delivery that you offer to your clients. For me, it could be able to dissect and study 20 companies' earning reports in the time that and the time that it takes me to do five, which is what I use AI for. I use it to consume data much quicker, and I use it to analyze data and draw correlations for me that I can then take and apply to an individual's situation. So there's different ways every industry can use AI, but if you don't have a budget line item for exploring how AI can make you productive, I would encourage you to figure that out and talk to others in your industry, talk to others and looking at how you do business, talk to friends. Everyone's got some type of AI app, program, something to consider. Um, I think that will allow you to become not get left behind in the dust and make you more productive. So, what can a business owner do as they look at their budget? I would create an AI budget line item, number one. And number two, I would keep some, talking out of both sides of my mouth here, I would keep a little bit of cash on the sidelines or a line of credit available. I used the analogy earlier of keeping powder dry. I we don't know what will happen in July of next year when Trump forces the renegotiation of our CUSMA negotiations with Canada and Mexico and the US, of course. So we don't know how far down the road he'll go. We personally don't think he's going to go down the shoving away these countries from dealing with the US and raising the tariffs. We don't think that's going to happen. But if it does, cash on the sidelines is always a good thing, line of credit available. What we always encourage folks to do is in times of weakness, look at your business and appreciate there's a weaker competitor out there that's strapped for cash. Or they may have a star employee that you're able to hire because they can no longer afford said star employee. So keep your ears to the ground, know your competition, know where their weak spots are, and be ready to take advantage of them. And this is a Warren Buffett line, but I'll rip it off here for a moment. Here is never waste the crisis. And I don't think we're tumbling into a crisis, but as we have this period of uncertainty that we are in and will continue to be in, those that are weaker business wise, you'll be able to take advantage. You will be able to find opportunities. There's no way that that won't appear. So I would strongly encourage you to continue to think about ways to grow and acquire, and whether that's people or businesses, I would encourage you to have that in your business plan.
You'd be surprised, like how many you talked about, like most of us can find 2 to 5 hours a week to, spend time working on your business, um, as opposed to constantly working in your business. Like we do coaching of some business owners, and there's a bunch of people that just essentially go from, one crisis, one fire to another, and they don't take the time to, take a step back and reflect. And I've coached some people where, like, hey, have you seen this in chat or have you seen this in Copilot? And even one of the things that you can do in chat or Copilot is, toss your website on there and ask it to do an evaluation of your website, or, kind of, ask chat like, hey, like, what should I be doing for marketing? Like, here's my ideal customers. Like, and you can toss in um, LinkedIn profiles to set up a customer persona. But um,
Mhm.
um, I'm appealing now to Kate of our marketing team, so I know she likes stuff like that. Anyway, um, um, right. So, okay, yeah, July Kuzma cash on the side, got it. Um,
An AI line item in your budget.
AI line item, absolutely.
Mhm.
Um, you know, um, I've been fascinated by I've been fascinated by concepts like game theory and herd trading. Like I think that was really big a couple of what like I guess around the start of or during the beginning of COVID with GameStop. Everyone like meme trading, I think was the term people use. But I know you've talked about at times the emotional side of investing, and I have my own thoughts of that. Like people you hear people like won't want to sell losers um because they're losers and they think they can't be wrong. But my thought is like on stuff like that, it's almost like poker. You make a decision, you put your money in, and then things change and you have to need to constantly be making decisions and reevaluating. But like, is that kind of like, am I out to lunch or what do you think about that?
So you're not out to lunch. Emotions, humans, I'll even go a step further. Humans left to their own devices are very poor managers of their money. I'm not a psychologist to totally answer the scientific reason why, but having done this for over 21 years, I could tell you that the reverse indicator that is the general public is shocking. When you're at the grocery store and the cashier is asking you if they should be buying Bitcoin, that means you should sell your Bitcoin. you know and humans in general are not the best with money, and that herd mentality, Trevor, is apparent at all levels of money management, even institutional pension management. There's this term that they use called window dressing, and window dressing happens at the end of every quarter where they have to disclose some of their top positions. Okay. And think about this, at the end of every quarter, for whatever reason, the top performing stocks during that quarter always do well because those pension managers are buying more of it to make it look like they've held more of it their whole quarter to make them look smarter. It's called window dressing. It's always a head scratcher. Never works. Never works. But it still happens, regardless of how advanced, how smart, how large of a portfolio you run, what your net worth is, what your business is. Humans are not very good at this. And so we create long term strategy. And Warren Buffett, is I mentioned his name once. It's pretty seldom I don't mention his name at least once an hour. Thinking of how he invests is how, frankly, we should all invest, where you don't care about that quarterly move. You don't care what they did that year. And Warren Buffett, just last week, actually, published his last letter. He has written a letter for decades now to shareholders about how what he sees in the world, where he sees opportunity. And in this letter, he wrote about the gaffe of Coke in the early 80s when they created a new type of Coke called New Coke, and it fell flat on its face. And he talks about that as one of the biggest mistakes that he watched as an investment because he got emotional with this decision and knee jerked out of some of the shareholdings that Berkshire had in the name. And he alone is also being vulnerable and sharing that emotions can affect your investments. And so being able to limit the emotion in the investment and to buy good quality businesses that you own for a very long period of time, you will make a lot of money. And I pulled up a stat because, Trevor, I knew you were going to try to talk about this emotions as it relates to investing. And if you just put $100,000 in the S&P 500 in the late 70s, or even, you know what, I'll even take you to the 60s and just leave it invested, that 100,000 would be worth over $60 million today. And that's
Wow.
not because I'm smart, it's because of time. Time compounds time. Time grows wealth. And so the longer you remain invested in great quality assets, you will make money. And that's our job, is to find great quality assets, help clients build up their savings, and allow the time to compound and grow so that you'll develop a lot of wealth that you'll be able to deliver meaning to towards you, your family, and causes important to you.
Yeah. Sadly, I didn't have 100,000 in the 60s, and I didn't choose my parents wisely either, but oh well. You mentioned Warren Buffett a couple times. Like I've been like I looked at Berkshire Hathaway as essentially being like a glamorous mutual fund. And I remember looking at it a couple years ago, and because I often get asked questions about well, mostly every client will say I don't want to pay tax. And but then yet they go and churn their portfolio. Their advisors sell it or whatnot, and so they end up paying tax. And I've told, like, looking at Berkshire Hathaway, I've said to people, if you don't want to pay tax, this was a decent stock at one point because they never paid dividends. So if you don't pay dividends, like you own the stock, you're only going to trigger a taxable event when you sell a stock. And then with Berkshire Hathaway, like I think I can't remember how many years ago, like out of 51 years, it went up in value 49 of those years. So it only lost value 2 years. And the CAGR, the cumulative average growth rate, was like 16%. So
Mhm.
like like if I would have had like whatever amount of money, I would have thought that would have been a good investment. But now I'm thinking, his partner passed away recently and he's not getting any younger and he's stepping down. And even I think I've read with him stepping down, the performance of the stock hasn't done so well because, again, kind of tying it back to the herd immunity, people think he chooses every stock. So I'm kind of curious when sadly he does pass away, like what's going to happen to his stock price. Probably I'm thinking going to go down or become stagnant for a bit because of the herd immunity, but like that would probably
Yeah.
be a buying opportunity too, like from what you're
So yeah,
saying.
if he were to pass and the stock went down 20%, I would buy the stock. I would absolutely buy the stock if I had a long-term view on that, Trevor, because Berkshire has an incredible hundreds of billions of dollars of cash available to invest. And he is leaving behind a group of very well seasoned, very well trained experts that, and the new CEO, he took over about 5 years ago. Greg Abel is his name. He's a Canadian, and he understands this investment world, and as Buffett says, better than he does. So as long as Greg Abel's the CEO of that company, you should feel very comfortable with that company. Great name, and Buffett passes away, stock will go down. Absolutely. We had that horrific event last year with the United Health CEO getting shot, and stock went down. The CEO does not move the stock price as much as that did, but it was the emotion of it that moved the stock down. And so that's take advantage, as I mentioned earlier. Be ready in your business plan to take advantage of things. That's my job when we manage money, is we look to take advantage of situations. And so that's something that we focus on. Absolutely.
I think even Berkshire bought some of that United Health, like
They
once
did.
that
Yeah.
sad event happened. And
Yeah.
I think it's come back, but anyway. Um, yeah, so I don't know, yeah, so we talked about a bunch of stuff. But if like do you have anything that's like key or actionable that someone could take away from this? Like from this session here, like, kind of a nugget, a golden nugget. The
I think
Mark's golden nugget. Feel free to trademark
Mark's Mark's golden nugget. There we go. So I think what I would offer is the reason to be optimistic. Again, as we started with, if you're over consuming media, you are very worried about the world around you right now. I would offer you a dose of optimism as the nugget, Trevor, by acknowledging that the world is getting better. Technology is improving our quality of life. It will improve our healthcare. It will improve everything around us. So there is plenty of reason for optimism. And if you're investing with a 6 month horizon, if you're planning on selling your business tomorrow, these are very different comments. But if you are thinking with a long term horizon, both to your life, your business, your family, your portfolio, I have to encourage you to think with optimistic views, to say that, well, sure, there's tariffs. Sure, there's plants closing around you. Sure, our dollar is only at 72 cents. But think of the opportunity. Find that opportunity in your business, your life. There's opportunity abound, and I would encourage you to spend your time thinking to the positive of how you can better your life with the future ahead of you. And I do believe that technology will be a big part of that.
Great. So I'll just jump in. So obviously the two of you have worked together for the benefit of mutual clients. Can you tell us just a little bit about the advantages of having both the advisor and the accountant collaborate when working for a client?
If you think of a dog and you think of the tail as the tax and the investment or the business being the body of the dog, they are connected directly, and so we want that tail to wag and to be happy. So from a business perspective, you and an investment perspective, you have to collaborate every single day together. So we work very well with our partners. GBA has been a long time great partner for our clients. So I would definitely say the dog tail we want to wag and to be happy. So before anything material, anything dramatic we do in a portfolio or you do in your business as you're growing your business, engage your accounting firm. And the more you pay your accounting firm, the better they'll be able to blue sky and to help you with your business. So it's crucial for you as a business owner and for me as a wealth advisor to have great connections with your accountants.
I'm not sure, but did you just call me the back end of a dog? I'm just like, I don't know.
No, I called you the nice tail, Trevor. It's okay.
Okay.
Don't worry
All
about
right.
it.
Yeah, I think from our perspective, it's we our philosophy is to be like collaborative both with our clients and their advisors, be it investment advisors or lawyers or whatnot. We like to have a collaborative working relationship with our clients and their advisors, and so like when people like Mark are like thinking of doing something that may affect taxes and they need to know some information, like we're open to taking their call and sharing our thoughts on not whether or not the actual investment is proper or whatever. That's his, like I said, that's his area of expertise. Like we'll just give our thoughts on from a tax point of view, if does it make sense from what we know to be the objectives of the business owner.